Hit that start button.
Good afternoon, everybody. Welcome back to Bull Sessions, our May 10th, 2022 edition. Quite turbulent times. My name is Mark Robertson. I am founder and managing partner of Manifest Investing. I'm joined here by my dear investing raconteur colleague, Ken Kavula. Good afternoon, Ken.
Good afternoon, Mark. Good afternoon, Kim. How are you doing this afternoon?
Windy as all get out here, but it's sunny and 80s.
Yeah, it's pretty nice here too. It's not 80, but it's much better than it has been. But we've got a full session on the plate here today, so let's go ahead and get underway. We are just taking a pause to celebrate the Kentucky Derby, where once again it was proved that people can overthink things and that anything can happen. One of the longest long shots in the history of the Kentucky Derby actually came from behind to win that thing on Saturday. I was just, I had forgotten. I don't watch it very often. In fact, I bet you I've watched 3 derbies, including Secretariat, and this one now. So I had forgotten all the pageantry. I mean, they're on for like 8 hours for a 2-minute race.
Well, that and my goodness, you better have, we women have to have a hat that must have a brim of about what, 8 inches all the way around?
Oh yeah, the hats are fantastic. Those look good on a future slide for a round table, maybe.
So, Mark, is the photo that we're looking at photoshopped, or is that really the horse giving us that big grin?
I don't know whether it's photoshopped or not. Somebody said it's a selfie of Rich Strike with the trophy. So he's apparently added photography to his skills also. It's a nice selfie. That's one of my favorite pictures of all time. We're going to come back to that one too. All right, our main topic today, though, will be the challenges of turbulent markets, turbulent economies, and just turbulent behavior and psychology, I guess would be the way to put it. And that's what the snake is all about, and we'll cover that. I added Benjamin there, Ken. Ken, you subscribe to The Economist, right?
Yes, I do.
And that's really just there because I actually heard from 2 or 3 people that said that I was too rough on the Fed a couple weeks ago when we talked about they had one job. And all I said was they performed it suboptimally. The Economist used much stronger language than that. So it's just there to say that it can happen. And of course, the situation has led to basically a state of panic that we are experiencing with investors. That's what the Scooby-Doo slide is from. And we'll spend a moment taking a look at Herb Lemkool's Groundhog portfolio, which has persisted near the top of the list since we began the journey back on Groundhog Day, February 2nd, and he's enjoying a little bit of ice cream there. I don't know if that's Moomers or not. Maybe Herb will chime in and let us know. All right, so let's go ahead and get underway. Lots of familiar names on the list, but there are a few new names. We try to keep this informal. This is your reminder that everything we talk about here is an educational demonstration. It's for illustration. No investment recommendation whatsoever is intended. We're simply trying to take the lessons learned and propagated by the modern investment club movement, whether championed by the National Association of Investors, now known as Better Investing, or Manifest Investing. So you're going to hear opinions about how to implement those strategies which have now served us quite well for approaching or over 8 decades. It goes all the way back to the early 1940s. So we will express some opinions, and we will try to remember to let you know if we happen to hold something that we are talking about, but please do your own homework before making any decision on any of the stuff that we talk about. We do a monthly program known as the Roundtable. We've been doing it now for about 12 years. Pretty neat results. The most recent one was pretty well received, and it's just simply a sharing of ideas. If you'd like to be added to that program reminder list, send an email to nkabula1@comcast.net. Again, we do it once a month. It's generally Tuesday evenings at 8:30 Eastern Time, and it is a webcast, and it is free. If you have any follow-up questions or would like copies of slides or anything like that, our 2 email addresses are down at the bottom of the page. Anything else, Ken?
No, I think you covered it. Good job, Mark.
All right, so let's start with good news first. And the good news, which includes some bad news, but the good news is Herb's Sin Soap and Soup portfolio has actually done his best imitation of Rich Strike. Am I getting that right? Is it Rich Strike? The winner of the Kentucky Derby? Something Strike. I want to say Rapid Strike.
Well,
Anyway,
I'm sure our audience is going to tell me. Somebody will tell us out there, Mark.
pretty sure it's Rich Strike. Well, he's done his own impression, and again, I realize, I hear you, K-Light. There's a whole bunch of months to go yet between now and February 2nd, 2023, but it is good to see somebody other than a rhino, one of those, either Warren Buffett or one of those other guys up at the top of the list. So Herb has taken the lead in the individual contest, and the Mutual Club of Cheney near Spokane is the group leader, and there's a number of interesting clubs on here, some new clubs, new participants that are in the top 40. And if you're on this list, you're doing far better than most of us. The average return to a participant right now is minus 24%, which is kind of a staggering number. We've not seen a number anything like that in 15 years. And it's really just, I think it's a powerful illustration of how challenging this market can be, especially in certain classes of stocks. And I just can't, some markets are more challenging for us than others. And it's been a long time since I've seen one quite like this. But Kathy Wood continues to struggle with her, what was somebody calling them the other day, Ken, about, you say early stages is generous description of some of those companies?
Yeah. You mean describing the companies that she invests in for the most part?
What's her adjective that they're using now? Unprofitable? Pre-profitable?
Well, pre-profitable maybe, but I don't know. I just think that she's either a visionary, and she's so much of a visionary that 99% of the population can't even imagine what she's doing, or she's just really stubborn and isn't going to change what she's doing. One of the two.
Yeah, I think there probably is some commitment to discipline there. And although, she bought General Motors yesterday, a fairly sizable stake in General Motors, which is kind of contrary. It'll be interesting to see how that works out, but she continues to be down towards the bottom of the list. But again, if you're on the list, congrats. Keep up the good work, and we'll keep hoping for you. The annoying monkey has moved into 7th place, Ken. So,
yeah, Mark, we have a question about beating the market. You're putting this up against the Wilshire 5000, is that right?
That's correct.
Okay, and I think if you pull the results right from the Manifest website, I think the Wilshire 5000 is actually on the list that you can take a look at.
It is.
And see where it sits. Mark looks like he's removed it from this list, but if there's 19 beating it, then the Wilshire 5000 is right in there between Petra Linden and Susan Malcolm then.
Mm-hmm. So anybody above 0 is actually beating the market, and
yep.
It's a much smaller field. Let's hope that everything gets better. Cy Lynch is on there, and a whole bunch of names that are quite familiar around here, including George Mackey and people like Lisa and others. All right. Well, here's a look at how Herb is managing to pull it off. And when I nicknamed the portfolio, he didn't do it. I did it. I nicknamed his portfolio Sin, Soap, and Soup. You'll see why. I mean, he's sticking to a fairly common theme here. I'm surprised he didn't put any ice cream on here. But you basically do have soup, suds.
And cigarettes.
Cigarettes. I don't think Herb smokes.
There's another that you forgot, Mark,
It really is quite a focused list. And it's doing pretty well. So, again.
We even have soda on here too, Mark.
What's he have on here?
Soda.
Yeah, he's got soda, and then he's got Clorox.
Yeah. Uh-huh.
He's got it
Well,
covered pretty well.
trying to keep your S theme alive here. Okay.
Yeah, I mean, it's an interesting approach, and I would expect it to come in fairly well faced with the challenging market that we currently have. So,
Herb, you're unmuted if you want to make a comment.
Yeah, it's really interesting. When I started putting this thing together, the market was starting to go down. So I tried to find stocks that just didn't have a whole lot of growth, but they weren't going to be a high flyer or anything else. So, but I think that as the market goes through its gyrations, that you're going to find that I will probably slip down on the thing because all the other stocks will start to come back. I think in about 4 months, everything will start coming back, and we'll see what happens when I start slipping down.
well, I hope you're right, Herb. Not to cheer against you, but it'll be nice to see some of those NASDAQ stocks come back a bit. One of the other things I wanted to point out, I assume you consciously did this, the amount of dividend yield in the portfolio is strong. In fact, when we keep track of the portfolio on the official live results, what you're always looking at are split and dividend adjusted numbers of shares. So all of these shares have actually increased since February 2nd, the actual total number of shares. So it's a total return contest, and every single one of yours, most of the groundhog portfolios have stocks that do not have a dividend yield. So the share count doesn't change during the year, but all of yours have gone up. So neat stuff.
It's interesting when you remember that total appreciation is the appreciation coming from the stock price and then whatever the dividend adds to that. So I'm just using growth as a proxy for long-term appreciation, and I'm adding it to the yield in this portfolio. And darned if I'm not coming real close to that 7% number we talk about for really large companies.
Yep. Nope, it's good. So good luck going forward, Herb. Enjoy your ice cream. And here is an interesting look at his sector and size diversification. Pretty committed to consumer staples and blue chip stalwart companies. And interesting stuff. And just the right recipe for the market as it currently is cranking along. All right, here's our weekly chart, or almost weekly chart, showing that the green price bars have actually dipped below the blue line, just barely. We might actually create some white space below the blue line here before too much longer. And so you're looking at the stock market price as represented by the value line arithmetic average. So again, that would be roughly the 1,700 companies in the value line standard edition, and basically their average price, that arithmetic average index. And we tend to think of that as a pretty good indicator. You saw it on the groundhog slide also of how the general market is doing outside of the popular indices that are talked about all the time. The blue is just simply a mathematical trend line, growth trend line through the data. And the red is basically the average result of a stock study done on all 1,700 companies, and those are presented quarterly. So you can see the 2008 excursion. You can see the COVID excursion on the right, and you can see that we have actually recovered. The stock prices have dropped enough that the return forecast is back above average as we sit here today, and probably going to take another ratchet up next weekend. All right, so let's talk about a few things. Here's one that I found kind of interesting. I am heavily invested in the NASDAQ in my groundhog portfolio. Therefore, I'm about to join Kathy Wood at the bottom of the list. The NASDAQ stock, this is actually from MarketBeat. Interesting little article that just basically points out that a whole lot about turbulence. And they make the claim that the performance of this particular stock, we're talking about the stock, NASDAQ, the actual company, tends to mirror the performance of the NASDAQ 100, and that's got the triple Q ticker symbol. So my first inclination, whenever I see something like that, is to fact check the author. I know that makes me different and cynical. Maybe it's the editor coming out, but I will go in and check. So I did run a quick check to see if that's true. It's mostly true on this trailing 5-year period where we're comparing in the blue the NASDAQ stock to the red, which is the QQQs. And I would say those two track pretty close together. And you go back a little bit farther, they separate a little bit more, but they do tend to mirror each other. I didn't know that. I was kind of surprised that that was the case. I would have thought that it would have been more volume sensitive to transaction volume, and just thought that was kind of an interesting point. Here's a look at the NASDAQ from the Value Line report. And again, I find myself more and more, we're going to talk about this when we talk about some of the other stuff here in a few minutes, focusing on this box right here, the revenues and the operating margin in the old Nicholson tradition. And those numbers are pretty interesting. The fact that it has come back down here to below this line here fairly recently suggests that it could be getting more interesting as a potential investment. And I have been attracted to the QQQs, but what you find when you subject it to a little bit deeper analysis is it's good, but it's not great. And, we're basically looking at a 7% growth. Really nice looking steady margins. Nothing wrong with any of this stuff. PEs that are somewhere around 20-ish. So we're looking at a projected return or a return forecast of about 7%, which reconciles very nicely with the projected return on value. It has taken quite a dive, so it is trading down near its 52-week low. But not great, good. Not necessarily great. And of course, Value Line has a fairly pessimistic outlook for it. So fairly flat.
Go back one slide if you could for a minute.
Excuse me, Ken, could you repeat that?
Can you go back one slide for me?
Mm-hmm.
Okay. I'm looking at cash flow of 1090 minus 250, which is 840. Minus 75 cents, which would be 675 times
775, Kim.
Yeah, if you're basically looking for a cash flow type price estimate, I mean, you're looking basically at $10 right here for current situation, and a price to cash flow multiple of 15. That puts it in that 150 price range, which suggests this number might be a little bit low.
Yeah.
So Value Line struggles with companies like this sometimes, and I think this one probably is a little bit conservative on this page as far as their projections go. Okay. Their earnings are flattening a bit. All right, so let's talk a little bit about the market. We are on the rocks every once in a while. One of the reasons I put this on here, Ken, you talked about this a little bit last week. These daily excursions are pretty interesting. And we're in the middle of one today, apparently. If the market is flip-flopping around 700 points again here today. And pretty choppy waters for the last several months. And those candlesticks are fairly large. They're not, order of magnitude large, but they are larger on the right-hand side. And I don't know about you guys, but I do feel it when the market moves around this much.
I do the very best thing that you can do. I don't look at my portfolio.
Well, that's.
Mark,
Go ahead.
I'm noticing a theme on the talking heads an awful lot. I don't think that they would mention more than once or twice during the day the VIX. That's the volatility index. I don't think they would mention that at all in 2021 or 2020 for the most part. But in the last 4 or 5 weeks, there's a number of folks that seem to have become entranced by the VIX, feeling that it has to move up into the high 30s, into the 40 range to signify a capitulation in the market. I'm using all the fancy words now. Signify a capitulation in the market and therefore signal the bottom. And I still don't understand the VIX, because the last time you and I tried to figure it out was maybe 12 years ago, 11 years ago, when you bought a share of the VIX, and we still had a difficult time trying to gauge exactly what it was measuring. You'd certainly think that this kind of volatility would raise that component, that volatility score, but it doesn't seem to, and it doesn't seem to take into account what the Dow and NASDAQ are doing. It seems to be focused on the S&P 500 completely. So I'm at a loss as to what that VIX really says. Can you give us two easy sentences on what it says, or are you still deciding to leave it alone?
Well, can I start with frustrating as hell?
Okay, yep.
Well, I'm not sure exactly what stocks it looks at, but it is measuring the price movement. The amount of price volatility is literally is supposed to be that. And you're mentioning the episode. I actually ordered it in the car on the way to Cincinnati, if you recall.
Right, right.
And my whole premise was volatility had been very low for a long period of time. And I figured any economic disruption was going to cause an increase in volatility. It did. And then the VIX went up. But the value of my shares of the VIX, whatever those are, whatever they are, they did not gain in value as I would have expected to. And when I'm right like that about a thesis, I want to be rewarded. And that's what kind of soured me on it. So I don't know.
Especially when people keep calling it insurance, that you buy into the VIX for insurance to hedge a bad situation in the market. And boy, it didn't seem like your one share was hedging very much when you gauge the return on what came from it.
Yeah, and I also think it's one of those. I think it's one of those gimmicks that the traders use. Right now, traders who are right about this up and down motion in the market over the last several weeks, they can make a lot of money. Going long, going short, going long, going short. And
the key word was traders, right? Not investors, traders.
And so they actually generate some of that themselves, I think. I mean, it's like a playground without rules sometimes. So I'll just
like giving a yo-yo a little bit of an upward pull right when you want it to come up towards you to help,
Yeah, I don't think I'm imagining it. So all right, we'll just.
No, I don't think so either. No, Michael wants to know if the VIX has changed that much in the past few days, and that's exactly the point that I was trying to draw attention to, Michael. That the VIX has stayed kind of stubbornly in the low 30s, and the technicians, the people that watch that number, would like to see it move up into the high 30s, up towards 40. So that the market would signal a true capitulation. You have all these different folks on television that have to feel that everybody has to do a long, dramatic death scene in order for the market to start over again and to recharge its batteries. They call it capitulation, and they're always looking for a VIX up around 40. And so far, the VIX is stubbornly stuck somewhere in the 30s, which begs the question, how the heck do you calculate it? How do you figure it? We tried to walk into that math 8 or 9 years ago and walked right back out of it again. And Mark's no slouch when it comes to math, and I'm no slouch when it comes to math. And the two of us had a hard time even getting past what they were using to set some of the standards for the whole concept. So I just thought I'd throw that in and ask if anybody in our audience was smarter than we are. There's probably 25 people, but I just need one of them to answer. That's all.
They all are, because they probably don't even worry about it. I don't know.
Could be.
All right, so here's a look at the NASDAQ 100, the QQQs over time. Just wanted to point out that the NASDAQ is actually more assertively down than the other major indices, and I'm kind of hoping for a turnaround here before I hit rock bottom in the groundhog. But here's the death cross that happened back a little over a month ago. The death cross is when the 200-day moving average is penetrated by the 50-day moving average, that red line penetrating through the blue line. And again, the people who watch the stuff, that's kind of a religious moment. They basically sell a bunch of stocks, and this sort of thing becomes a self-fulfilling prophecy in some ways. But the panic is well on. I mean, you can look and see that the relative strength index reached a low here and a low here. Here's another low here. Here's another low here. Theoretically, that would have been a safer time to buy. We seem to be headed back into that territory. In fact, I think we were at 30 sometime today. So who knows? And the stock market has continued this rather abrupt downward slope, and as stock market here as measured by the QQQs. And the other thing that comes to mind here is the point we made just briefly last week was we had talked about how some of the stocks, the Microsofts, the Apples and Johnson & Johnsons all get disproportionately more funds anytime you invest in an index. It's true on the downside too. You know, if those funds are actually sold off, the index funds actually have cash outflows, it aggravates the situation. We talked about that briefly last week. All right, so panic ensues. Good, clean fun. All right, so let's switch gears and talk a little bit about Michael Mobasan. He is an interesting guy. He's one of the authors of that Expectations Investing book. I have cracked the cover on it, read a little bit of it. Here's just a reminder, one of the reasons he attracts our attention. This goes back about a year and a half ago. One of the funds that he is affiliated with is at Morgan Stanley now. He actually has a long track record, including Legg Mason Asset Management a few years ago, and he's very well respected in the industry. And he's now with Morgan Stanley and specifically this sub-advisor group on a fund at this time that was actually leading our lifetime performance results. It has since fallen off the chart because he's invested in stuff, the fund is, very much like Kathy Wood. And you see that here, the actual price of the investment on a unit price basis has taken quite a tumble. So he's obviously fallen off the list, and just kind of an interesting thing. One strike against reading the book, but he does have a good track record, does say some pretty interesting stuff. And I ran into a tweet this weekend that we're going to actually spend some time with. But one of the reasons that he is in our crosshairs is because of this performance and the track record. This article down here does have a bunch of different references. A lot of the stuff that, Kim, that you suggested are accessible right there also.
Yeah, because I had said, just for everyone in the audience, I had found that all the articles by, I can't pronounce his name, Mark, you do so much better, is I had found that all of his articles have been placed in one place, and Mark knows it and he can post it in the forum because all of his articles are so good to read.
Yeah, he does have a pretty good head on his shoulders, and I think the drift at that one fund is not necessarily indicative of what's going on here, but it is one strike. Anyhow, I thought that the 8 points that he made, and I thought we just spent some time kind of scratching our head over them, were actually pretty good. I think, Ken, you pretty much agreed, maybe with some slight tangents here, but you can actually read the entire thread. You don't have to do Twitter. You can actually go here, and they've actually compiled the Twitter thread where they basically number them 1 through 8 and make a string of comments because of the text limitation on Twitter. But fairly powerful reminder that we really should be mindful of the fact that you are becoming a partial owner in a business. And it's about more than the stock price. And this notion, this rhymes with Buffett's advice about, what if they closed the stock market and you couldn't buy or sell your company? I mean, some people I think would just go berserk not having a stock price, but this kind of falls into that realm of I think I'm best as an investor when I do the tree falls in the wood approach, where I don't pay quite as much attention, don't hear the trees falling so much. Your thoughts, Ken?
Well, I have the exact same thought that he was channeling Buffett in this first paragraph here, but I would like us to find a way to continually remind beginning investors, especially, that stock price really plays a fairly small role in deciding whether or not a company is investable and whether it has a high quality and all those kind of things. I mean, stock price comes in near the bottom of the evaluation as far as whether it's time to buy or not, and that's such at odds with almost everything that you pull off the internet, that the first thing they do is slap a stock price chart up in front of you and expect you to evaluate a company based on what the price is doing. So I really like this gentleman's approach to investing. All 8 of his points seem to be very cogent, and he seems to play well with the kind of ideas that we've been talking about for years.
Oh, I'm sorry, Ken. I was just checking my Robinhood account and looking at all my stock prices. All right. Point number 2. I think this has to be right up Kim's power alley. It really comes down to judging the success or investability or desirability of investing in a particular company based on their return versus the capital structure or the cost of capital of the business. So, Kim, is there any truth to the rumor that you framed this one and it's hanging on the wall of your office?
Comment.
Point number 2.
Yeah. Point number 2, that very much look at that. I also am very much cash flow and how is it going to go forward and how effective is management and is management's, I am getting more and more, I want to know what management's executive compensation is, because they're going to be motivated by making money, and that doesn't necessarily mean they're doing for the best interest of the investor in the company.
True enough. Anything give you heartburn there, Ken?
No, again, I think he's playing in the same ballpark we are, Mark. He's talking about relative numbers. He's talking about beating a standard. I think I could even stretch this one a little bit farther and make it say, if you don't earn anything, you really can't return something to give back to shareholders.
Yeah, and in fact, I had that same thought that these two are a little bit in conflict with each other because he downplays profits, but profits are a part of this. So, oh well. All right. Here's where I think it comes home to roost, and this is we'll spend some time talking about this a little bit, but this return that I think he's talking about, or I think many successful investors think about, basically the road ahead based on their visual analysis of what is the profitability, whether you're looking at earnings or operating margin or cash flow, some measure of return in the future. We obviously have a favorite, that's that projected operating margin, but divided by the capital or the value of the company. So the enterprise value is in the denominator. So again, it comes back to Nicholson and Ralph Seeger's very first sharing of the stock selection guide and the emphasis on understanding the business. Again, that's what Michael was talking about. Understand the business. Haven't even begun to talk about stock price here, except it does appear in the value of the business here. But as far as the current quotation or whatever, the emphasis is on the top line, sales or revenues, and some form of profitability, whether it be earnings or pre-tax profits or anything else. So I do think it really does come down to this stuff. All right.
I've been watching this slide, Mark, for a long time, and I've been thinking of a couple of changes on it because we've used this particular slide probably for 4 years now, maybe more.
Mm-hmm.
And I'm looking at the fourth bullet, and I'm going to just give you a gentle nudge because I'm wondering if that fourth bullet, that sentence that's there, that phrase that's there, should continue with the words "and when they don't, dot dot dot," fill in the blank. Because I think I'm talking about that one right there. Because I'm thinking that's been, for me at least, the eye opener to this whole concept of proof, and that's using it as a validator for what I'm doing with PEs and with SSGs and with preferred procedures, the whole 9 yards of it, and watching very carefully when the proof number and the par number diverge significantly. That's been the key takeaway for me, at least, on the value of this particular metric.
Yeah, and I will say, Nick Strategos is one of the first things that he mentioned or noticed a few years ago, and it really is impacting our database by triggering some of these, as you just suggested, basically using an algorithm to look for the differences and really explore the differences. So yeah.
I still believe the fifth bullet, the population of results are more stable and enable analysis early, et cetera, but I think we originally thought that was going to be one of the more important things that this helped us do. And in fact, I think one of the throwaways, which is the one right before it, turns out to be the one that seems to have the most use, at least in everyday stock analysis.
Mm-hmm. Yeah, it's getting very interesting as we refine it, and it populates the entire manifest database with audits on almost every single stock now. Time doesn't permit me to go into it, but we will be covering it in some detail. Here's that fund that 18 months ago was leading the chart. And one of the things I wanted to point out, this is a little bit of Monday morning quarterbacking, so I apologize, but maybe not. Because you may recall back in that time frame, we had noticed how some of these funds, including Kathy Wood's Innovation Fund, were suffering under this condition, where their projected return on value, and for that matter, their projected return from annual return from par, were way below average compared to other funds. And it made us scratch our heads, and we were basically saying something's wrong here. Well, what if they were right? And what if these funds were actually exposed to more downside risk? And it was actually giving us quite a signal, which ultimately became more reliable. Now, again, I realize there's a lot of cognitive bias at work here in Monday morning quarterbacking, but I can remember sitting there looking at these numbers, specifically these numbers, and really scratching my head. And here's what's actually in the fund now. I would say they still haven't really put it back together yet in the way that they probably should, but this is definitely better than it was. So
I think just playing on what we were just talking about on the previous slide, I would fully expect in a well-balanced portfolio, half or 2/3 or maybe even 3/4 of these stocks in these last two columns to have numbers that were roughly equal to each other. I mean, go down to OSTK, for example, which is about 7 or 8 down with a par of 18.3 and a proof of 16.5. That's the kind of match that I would expect, and I would expect it to be happening in a much greater percentage than it's happening in this sample that we're looking at right here.
Yeah, and you can, I think this illustrates pretty powerfully, even more powerfully than I give it credit for. Snowflake which is a company. I'm not even sure they have earnings yet. Somebody
They
in the
don't.
audience might. They probably don't.
I know they don't.
They don't. Okay. So Snowflake, I can tell you what's wrong here. What the analysts are estimating for earnings, basically 3 to 5 years out, in combination with PEs that are off the chart, they're just not. There's a lot of hope in there. A lot of
Well,
hope
Mark,
might not be fulfilled.
look at a few of them near the bottom of the chart. Look at Bill, and I have no idea what Bill even is, but a par, in excess of 25% with approved less than 3%. There's something out of whack there. The symbol U, I don't know who carries the single letter U as their symbol.
Oh, I should
But
know.
again, 22% versus 0.4%. And there's just too many of those on this list for me to think that this might be some kind of a fund that I would want to invest in. Maybe we're looking at a really great way, Mark, to evaluate, or another way to come up with some data on mutual funds in general, to come up with some way to rank these percentages of values that are close, based on the percentage of the whole that they represent in the portfolio.
Yeah, and it would expose the ones that are swinging for the fences. One thing that I will say is this has a disproportionately high number of mismatches. And the other thing that I would point out is with the end of the first quarter, as we roll through the first quarter updates and basically ratchet forward a year in the database, these are getting caught. These are getting called out and caught. And it's kind of interesting to watch. For example, a company like EPAM, which is much more well established, 13 versus 9, I consider those the same number. So we're seeing that type of matching up as we progress through the database. So interesting point. I didn't realize how powerfully this slide actually made that point. I'll be coming back to that.
Go back one slide again. The other thing that I thought was real interesting is Circuit. Its annual return is 8.5, but its proof is 17.5. I don't know if I have found another stock in this whole list except for RPRX where the proof is higher than the annual return.
Yeah, and there's a case where the analysts are probably a bit more pessimistic with Cricket.
Or a lot more pessimistic. Yeah.
Yeah, it's a great audit driver, a great audit trigger, and that it'll be a big part of my Dallas presentation on this subject and showing it in a worksheet type approach. Okay, let's go ahead and keep cranking along. Michael has to say, this is the song you were singing last week, Ken. Point number 3.
Yep.
And when stock prices move around so much, it's just not right. So that aspect of the book is going to be a lot of fun to get into. All right, and point number 4 kind of dovetails with it. Again, this just makes the point: as prices go down, return forecasts go up, and you got to love slim pickings.
And the reverse of that, Mark, is something that we need to drive home with manifest users. I can't tell you how many times I've seen people that I expected to really understand a dashboard and to understand the relationship between a really great momentum stock and its par value. And in fact, the opposite conclusion was drawn for a stock with a par at 3%. They were being classed as stocks that didn't have anything going for them, rather than stocks that probably had an awful lot going for them, maybe more than was healthy. Maybe the price had gotten way ahead of itself, but you certainly didn't sell it because the company was falling apart just because it had a par of 2 or 3. You investigated what was causing that par, and many times it's the price pushing itself up which forces the par to move the other direction. That's exactly what he's saying right here.
Yeah, and that certainly made managing Tin Cup, or not just Tin Cup, but the round table tracking portfolio interesting there for a few months, as you
Yep.
recall.
Yep.
So interesting
Well,
point.
and Mark, especially when you're in really volatile markets where you know as a data user that the data doesn't always stay as current for every single stock as it needs to. And we would see stocks where the par would say 2, and we knew that that number wasn't right, but the data was right with it for the moment.
Mm-hmm.
Things just were moving, and they still are today, moving so quickly with these huge swings up and down and up and down that I worked with a stock for our stock meeting this evening in the BI Baker Club, and I looked at the projection value for the end of the fiscal year. Now, they already had 3 quarters into the fiscal year, and you would expect that the end of the fiscal year would be somewhere near the fourth quarter, either up a little bit or even or down a little bit or whatever. But the projection point was down below the annual value from the year before. Obviously, the analysts have not gotten to this stock yet. They have not sat down and done a reevaluation looking at these 3 quarters and trying to decide where the end of the year is going to end up. But the company would have had to lose significant money just to make it down to where that dot was being placed at that time. I just think that I'm going to read right off the screen here, if you stop worrying, and love the whatever it is you're going to love, it's going to maybe take a lot of the guesswork out of the wealth management. Stop worrying about some of these things. Use your good common sense and realize that there is no magic bullet to tell you how to get rich.
Yep, and don't overreact. And in fact, Kim,
Yep.
I actually put your slide in there. This was a tweet that Kim had retweeted at me. Just a reminder, and it dovetails with what you're saying, Ken. Understand businesses. The stock prices can be crazy, and as Kim pointed out, back at the crucial moment following the dot-com collapse, the bursting of the bubble, these companies were all down significantly. Then look at the gains. So
Microsoft only made 1,200, Mark.
only. Good stuff.
Yeah, look at Amazon and Nvidia. I was like, holy crap. An Apple?
And every time we ask Herb Lemkool while we're holding NVIDIA in the roundtable portfolio, he should pull up this slide.
Yeah.
Giving him more fuel, or I gave him more fuel, didn't I?
Yep. All right, point number 5. And this goes to Ken's green room comments about CNBC and some of the stuff. I don't know if you were talking about it later, but some of the stuff that we see on financial porn, which is the financial media, can be quite unreliable. Or should I say suboptimal and wait for people to write me letters? Poor predictors. And very few people actually keep track of that stuff either. So be macro aware and macro agnostic. Love it.
I'm not a great fan of the word probabilistically, but that's exactly what you have to do. How likely are some of these things going to be? How likely will it be? Mr. Kramer just said it this morning on his program. How likely is it that every single switch that's going to be thrown is going to be negative? That's a pretty big probability when you have 50 or 60 switches to throw,
Yep. All right. So just be trust but verify when you're watching TV. Point number 6 is just a perfect reference to what we're going to talk about as we close here today. This exogenous shock. He uses big words. But yeah, COVID, and then of course our friendly snake there with hopefully that's not. No animals were harmed in the making of this presentation. But yeah, it's been quite a shock, and we're going to cover that in a little bit more detail. Here's a little bit of fun. Maybe it's fun. Maybe not. Many of you are familiar with one of the books we featured not too long ago, Factfulness, which goes through and challenges a number of assumptions that we make about daily life in a number of different areas. And I thought this would be kind of fun. Here's just a question for the audience. Since the president was elected, has domestic energy production increased or decreased? Of course, the other way to word that question is based on what your perceptions form following watching the nightly news. What do you think the answer to that question is?
How about a better way, Mark? Based on what we're paying for gasoline prices, what do you think domestic energy production has done? Increased or decreased?
That's all part of the narrative that's not true. And gas prices at the pump are actually not at an all-time high. So it's just amazing the stuff that comes out of that book. And here's the answer to the question. I find this kind of stunning because production of those major energy sources has actually gone up, not down. But you can't prove it by watching the news. So, again, use facts. All right. And point number 7 and point number 8, this is a great reminder. Those of you that are fans of the book, The Intelligent Investor by Benjamin Graham, and the most recent version was redone by Jason Zweig. Highly recommended reading. I actually followed Michael's instructions or suggestion, went back and looked at it. We'll take a look at a couple of quotes from chapter 8. Yeah, the market's crazy. Accept it, deal with it, and profit from it, as we'll see. I didn't have a copy of Keynes' General Theory, but I'm hoping Ted from North Carolina will send me a copy. He's probably got a few. And then, of course, I've not looked at the Zebra book. Did you get a chance to dig into that one at all, Ken?
No, I didn't. I'm not going to tell you why. I just didn't. Okay.
Well, we haven't talked about zebras since Ralph Wanger. Maybe it's time to bring back zebras as one of our favorite animals. I'll have to take a look at the book. But again, it's a matter of keeping things in perspective and being patient and disciplined about everything. Here are those 2 quotes from chapter 8. I'll let you read them. I mean, these are straight out of the book by Benjamin Graham, mentor of Warren Buffett. And I'll just admire the golden rhino pendulum while you read. And I think it's a good reminder, especially in these days of very powerful pendulum swings.
I don't know where the overlap is, Mark, but that little piece of quote on the previous slide about stress being a shortener of your available time to deal with a problem is also a key to dealing with people in a counseling setting and in a educational setting as well.
Mm-hmm.
The last thing you want to do is stress your client or your student. You want to try to make and that's something for the teaching profession that a lot of times is very difficult not to do. It's not to put extra stress on the student if you want optimal results. If you want the best results, you have to find as stress-free a dynamic as you possibly can to do whatever it is you wish to do.
I agree, and it's just a whole thing about temperament. And maybe that's such a big part of investing. I was on the phone with a friend this morning, and basically pointed out that one of my investments was down 40%, and my response to that was, "Isn't that cool? I get to buy more." And Hugh McManus does that too, where he'll have an investment. My investment in the QQQs has been rocked pretty hard. So what am I doing? I'm thinking about actually averaging some more into it. Because I happen to believe that those 100 stocks, a couple of them are going to go away, but in general, that's a pretty good collection of stocks. I just think this is just such solid behavioral type advice.
I think the ability to compartmentalize also is important, Mark, that once you've made a decision, for heaven's sakes, don't spend the next 5 days agonizing over that decision that you've already made. Let it be, set it aside, and deal with the consequences after it's had some time to do whatever you intended for it to do, or maybe to do whatever you didn't intend for it to do. But keep it away from the front of your cortex there so that it doesn't drive you nuts.
Yeah.
Dan, I'd also suggest that anytime you have a buy or a sell, because I've been starting to do this, what was your reason behind the buy? What was your thinking process at the time? Because that way you can go back and, oh, God, was I ever wrong on that thought process, to make sure you're not inadvertently doing the same mistakes, or if you're doing the things right, maybe you might want to know what those steps were that you did it right.
Yeah, and the one that comes to mind for me, Kim, is PayPal. I mean, there doesn't seem to be anything fundamentally wrong with the company, yet the price has been just massacred. I mean, that's one that I would think you would go back and say, gee, I'm looking at all these fundamentals. Maybe I acquire some more shares of this company. Good stuff.
Exactly. Yeah.
All right. Just a quick insert of the manifest for the leading fund, so you can see that Michael's fund's not here anymore. Neither is Kathy Wood's, and that kind of stuns me. But the thing I wanted to point out here is that the projected returns on value are actually stabilizing. These numbers are matching up much better as the updates are progressing through the whole thing. There are some very interesting sources of ideas on here. One that I do find kind of interesting, I'm not a big fan of leveraged investing, but I do find this fund a fairly interesting one. It is a one-time leveraged fund into the mid-cap 400. So it basically is giving you a 2-for-1 leveraging, which would, in the case of these types of companies, would not be incredibly risky. Again, if you're risk averse, just go get a cup of coffee. But I do find, especially with our recent theme on the workhorses, I find those numbers to be kind of interesting and probably something that I'll track. All right, so let's talk a little bit about what has happened here in the recent past, not too recent past as far as COVID and the food moving through, or I should say the meal moving through the snake. And this was definitely a moment, with two parts. The first part being COVID hitting in March of 2020, and then the consumer reaction in the United States, at least, which is massive. And that basically is the stimulus funds and everything else. And it basically has made a bit of a pretty nasty situation, which we're going to have to live through here for a little bit. Here's a look at the chart, not just on month over month, but year over year, much like a stock selection guide. And you can see that, here's your COVID moment. Here's the rapid recovery. You can see that the slope of this is definitely different than the slope of this. So we are in a moment, a fairly challenging moment. In the meantime, the rest of the world is not. So that is a nutshell description of what's going on in the investing world right now. Toss in an invasion or two and a few other things, and that slide actually captures the turmoil of what's going on, because this is not sustainable. I hope Lou Kaiser doesn't ask me to explain that. It's just not. All right, so what I thought we would close out with is just a quick look at 4 companies that I think are at least mini poster children of what's been going on. And Ken and I had some fun with these earlier today. Peloton, upper left, basically spiking up with people jumping on their exercise equipment when they were imprisoned in their homes. And then not so much here over the last several months. Second one on the upper right is Netflix. And Netflix has had a heck of a run over several years. And that apparently is snapping to a close with some of the stuff that's going on there. The stock price has been cut by 60 or 70% from its all-time highs. Lower left, Zoom, again, another company that benefited from the pandemic. And the stock price has been struggling fairly mightily over the last several months. And the last one on the lower right is Emergent Biosolutions. We're going to spend a little extra time on that one. That's just one of the types of examples of companies which had an incremental benefit from the COVID solutions that it became involved with, along with some turmoil and controversy. But I had no idea that my fairly recent selection for one of our stock panels was once again suffering, Ken. You probably knew that.
I'm not going to comment. I'm not going to rub anything in, Mark. Okay.
You know, I was doing so well after I picked it at the last stock panel.
Well, that note that you sent to the company telling them you picked it for the stock panel just took a little bit of time to arrive, you know. I didn't realize that Netflix had actually moved with a relative value beneath. Is that beneath 20 or beneath 30 there, Mark?
It was approaching 20 last week, so that's actually the longer term chart, the monthly. So the dailies are actually probably down around 20. Okay. And that's a little bit of a different story. So in keeping with what we've been talking about for the last several minutes, when we look at these companies, we really shouldn't overemphasize the price, even though that's all is done in the general market, but instead turn to this. And I think this shows in fairly stark relief some of what we've been talking about. I mean, the rapid gains in Peloton during the pandemic, and then obviously the flattening. The company had a report this morning which was not better, so they're completely flattening out. It'll be interesting to see. And then, as Ken likes to point out, this translates to they don't have earnings. So
the lack of a blue line, you mean, Mark?
The lack of a blue line is a problem for some of these companies. Yeah. Netflix has actually kind of tapered off too in advance of what's currently happening. Again, when you watch these businesses and understand them from the top line and the profitability line, it really does get kind of interesting. Netflix has this plateauing going on here and a real significant messaging and communications challenge in their not too distant future. I would put Zoom in the same category as Peloton. Again, if you're drawing an image of what this company might have done and you're back in the 2021 timeframe, you may be looking at a slope like this. And that would not have been a really good idea. And then, as Ken wanted me to point out, you may not be used to seeing numbers out there as part of the trend for the next year and the year beyond. So we actually have estimates for 2022, 2023, and 2024 in here. I mean, just look at, if you cut this off right here, a traditional stock selection guide, what are you looking at? And that's true for all these companies. If you basically don't have the operating, continuing company, in your crosshairs, you could basically make some pretty drastically large assumptions about growth expectations, and that's the whole deal. We try to avoid that. We tried to avoid that with Emergent. That's precisely what you see here. This company is an established company. They make the Narcan for law enforcement, the opioid solution for patients who need that. And they also make a whole bunch of stuff for government employees traveling overseas. So they have an existing business. The government came to them and said, "Can you help out with COVID vaccines and stuff?" That's what this bump is. This bump above the red trend line, and then the return to something after that. And so there's a whole bunch of companies. In fact, let's go ahead and there's a whole lot of question marks about what will the profitability look like if they actually ever reach the point where they're no longer making vaccines. And that's what this all represents. One of the ways to avoid getting into the trap of thinking that this is something which will continue forever, and it might, I would think the better analytical bet on it would be to say that trend line through all of this data is probably more representative of what you might reasonably expect from a company.
I will say, Mark, that my recent experience is that the analyst community is having a little bit of a difficult time figuring out how to come down from one of these bump ups. And it appears that in a lot of cases they're overshooting on the downside, the same way they missed the fact that the company was going to have better than anticipated earnings during the cancellation periods during the COVID times. The analysts just aren't really good at these out of the ordinary kind of moves up and down. And I think that when you see a picture like this, I would take those two dots that are horizontal to each other and that are down beneath the trend, and I would take them with a large grain of salt until I began to see more data, more facts that prove that that's where we were headed with those particular dots. I just have found an awful lot of companies where the analysts have overshot in both directions.
Yes.
Well, Ken, I agree with you. But I think the other thing is these analysts have never gone through a market like this, so they really don't know what to do.
Is that a poke at the fact that they're all under 30, Kim, or what?
Considering I'm over 30 and double that, yeah.
So again, our point here is for a company like Moderna, and as Ken even went so far as to say Pfizer and other companies like that, you have to basically look at them through some type of a lens which tries to take this all into account. And you're right, Ken. I mean, the whipsawing that goes on, the pendulum that we talked about a few minutes ago, it's in full force here.
Yep.
All right, so back to our rabbits and how we're the ugly picture there, the rabbit in the snake. We are in the middle of this situation. Found an owl with his hand up where you can. We're actually doing better than we had been, but we continue to trail the market by a little bit, but we are significantly outpacing the Russell 2000 growth. That's an ETF. So our recent selections, our replacement stocks are performing well. And I do think if you want to do some homework and you're in the audience and want to do some homework, take a look at a stock study on these, and you'll see that, perhaps was Mark falling victim to a little bit of this little bit right here with a company like Sharps Compliance. I don't know. I like the company. It has continued to underperform the market. They basically make this all the services and processes for disposable waste from medical facilities and pharmacies and that kind of stuff. And it's a pretty good picture long term. Did they have a bubble up, from the pandemic? I don't know. But did I fall into that trap? By the same token, I'm pretty sure, Ken, these guys made protective equipment, personnel, protective equipment and clothing. Superior Group.
Yeah.
They shifted, Mark. They're a uniform company, but when we had great deficits in PPE, they shifted and began manufacturing it for the hospitals and the nursing homes and places that needed it, and left their other business basically without inventory for quite a while. I'm reading, at least, because I happen to have this company on a short list, this Superior Group on a short list. I'm reading that they're having a little bit of trouble getting themselves switched back to getting the inventory built up to a stage where they can get their sales moving again toward their traditional customers.
Wow. Interesting. And iRobot is basically a victim of that world GDP graph that we threw up a few minutes ago. So,
Mark,
continue.
have you noticed the one trend that's been happening in the last 3 weeks, however? I've been kind of tracking these relative return numbers now on a pretty regular basis, and as a group, every single one of our banking stocks has moved up the list. They've moved. Axos had been as low as the mid 20s negative, and Axos is now up to negative 15 relative return. Southern Missouri Bancorp had been in double digits negative, and now it's at negative 4.1. There's a couple of other ones on there also that have moved up the list, and I think that that's going to continue as the Fed continues to tighten. The initial knee-jerk reaction from the market when the Fed tightened 3/4 of a point, half a point this last time, was to punish everybody. They punished the banks right along with everybody else, and I think the banks are going to come out of this a little bit faster maybe than some of the other companies that we have on our lists here. So I would like to kind of keep an eye on them, and if they turn around again, I think that's going to be telling as far as what the general market is thinking about where interest rates are headed.
Yeah, the one thing I do notice is when there are more green numbers over here.
Yep, they're definitely.
We'll take those. And the other thing I notice, you talk about understanding businesses and understanding stories behind them. MYR Group is substantially involved in infrastructure projects, and just a pretty good tailwind behind them. So we'll continue to be hopeful. All right, there's the book that we're probably going to get into a little bit deeper with our Michael Mobasan in the future. And then I would just want to remind everybody that Just Keep Buying from Nick Majuli and Why Does the Stock Market Go Up from Brian Feraldi is also two books that we might take a look in greater detail. Your reminder that we have all of these sessions, including roundtables and our panel discussions and special sessions included. I actually broke out the successful investing workhorses on the mid-sized companies, medium-sized companies as a separate presentation that's also included with the roundtable from April, and some shorts on some topics. And Sean just sent me another one, so there'll be another one there shortly. So please consider subscribing. We'll let you know if we add content. And we're back to the selfie from the champion of the Kentucky Derby. Probably going to become one of my favorite selfies.
You gotta love an underdog that pulls it out.
All right. So with that, one last slide here. I thought we would try an experiment here. For those of you that watch the race, if you haven't seen it from the aerial view, this is pretty cool. I'm not sure how this will behave. I'm going to try to actually run a live video and see how that works. I think I am anyhow. And it's only 50 seconds long. But if you haven't seen this, oh, can I go to it? Maybe not. I thought I could go right off my slide.
Well, you can, Mark, but there's a couple of switches you have to throw in GoToMeeting to make it work.
Okay. Can you see that okay?
Yeah,
Yeah.
it's showing. It's showing.
All right. So he's at it's Rich Strike, obviously. And this is at the 1 mile mark of the race. It's only a 1.25 mile race. Now watch this. I mean, he's in 15th or 16th place. These horses at the front are running at an all-time record speed for that segment of the race, by the way. He was an 80-1, heavy odds against him. There it
You
is.
should see the jockey at the end of how much mud's all over him.
Yeah, it was quite an event. So I would encourage you to go. Uh-oh. I may have left something running there. All right. So with that, anything else, Ken?
No, we've kept our questions pretty well covered here. I'll just make a comment from, let me get back to my questions. There we are. A comment from Dennis that says, a way to keep yourself humble is to keep a picture of your high school yearbook picture right in front of your computer. Okay.
Well,
For me, it's a prom picture. Oh my God.
Prom picture. Okay, you got the idea.
well, Dennis, we use all of our high school pictures for the program brochure at the National Convention.
So,
I actually have brown hair in my picture, I think.
but I actually have hair in my picture, Mark. There, I'll see you one and raise you one. Okay.
All right. So with that, we did run a little bit long, but I think it's an interesting topic to think about, these pendulums and the opportunities that are created if you have the right mindset. So we'll leave it at that. Thanks, everybody. Get out there and
Have a great afternoon, folks.
Bye-bye.
take care, everybody.